All right, let's look at question number 4 from last semester's exam paper. The following ratios have been calculated for the most recent financial statements of Playbox Limited and X-Station Limited. Both businesses operate as wholesalers of the gaming console business. And we're given a little bit of information there. Now it tells me to compare the profitability, solvency and liquidity of the two entities. So what I need to do is I need to talk in these words here. Profitability, solvency and liquidity. Now last week we talked about how do we group our ratios together so that we can look at what's called profitability. Now my profitability ratios are there. Oh yep, okay, that's it. My liquidity ratios are here, and my solvency ratios are there. So profitability, liquidity and solvency. Now we were asked to compare the two of them. I might be able to do this on the one page. Here we go. So we're asked to compare the two businesses. Now I can sort of straight away, first I'll talk about liquidity. Now looking at this, I've got to understand what my ratios are talking about. But X-Station has a current ratio of 0.9, Playbox 1.2. I'm going to give liquidity in that sort of situation to Playbox. Playbox collects its money from customers in 40 days versus 45 days. I'm going to give it to Playbox. The average days in inventory is 25 v 52. Going to give it to Playbox. Okay, so those numbers are better than those numbers. So my liquidity, an answer, a comparison of current ratios suggests Playbox is more liquid. Now being liquid means it turns its money into cash a little bit better. In other words, it can pay its short-term liabilities as well. So we've got enough current assets, because my current ratio is my current assets over my current liabilities. I've got enough current assets to pay my current liabilities. So my short-term is looking better here than here. This is indicating I might not have enough current assets to pay my current liabilities. So it's an indication, it's not a certainty. Also, if I look at this, I've got a turnaround of 65 days here versus a turnaround of 97 days here. So, Playbox takes 65 days to convert inventory to cash. The X-Station's 97 days. And that's ticked off liquidity. Alright, so next I'll just do solvency next. So I'm talking about these two here. So my solvency is my debt to total assets. Well, X-Station has higher debt to assets than Playbox. So I'm just going to give Playbox a bit of a tick. And its cash return on sales is 3% here versus 4.6%. So indicating that we're making 4.6 cents per dollar in sales is a cash return. So I'm going to give it to Playbox as well. So my solvency indicates what does insolvency indicate? Debt to assets for Playbox is, what is it, 6.8% lower. The next station, indicating better solvency. Now it's not much better, but it's better. Profitability. Now, when I was doing that question, cash return on sales is a profitability margin. So let's have a look. So solvency, this is the last one's profitability. So my profit margin, 3.4% versus 4.7%, going to have to give it to Playbox. Return on assets, meaning that for every dollar of assets we have 9.2 cents of profit versus 7.3 cents. So once again I'm going to give it to Playbox. And return on ordinary shareholders' equity, once again the higher number is better, so I'm going to give it to Playbox. So now my profitability, Playbox higher profit margin, so Playbox has a higher profit margin, greater return on assets, and a higher return on shareholders' equity. Oops, it's on. It is also making better cash returns. Of 1.6%. That takes care of option one. Now it says select the company that is in a more sound financial position. Well, easy, Playbox.